Hello, everybody. This is Bob Plexus. I am president of All-Star Financial, and I welcome you to the All-Star Financial Quarterly Review Fourth Quarter 2011 webinar entitled New Year, Same Old Concerns Remain. Before we get to our outline and review of the newsletter through the webinar here, I do want to talk a little bit about Bob's Corner on our front page of our newsletter. We are really introducing today a new global index that's more representative of what we do as asset allocators. It's called the Global BMI Index. We have used in the past the Russell 3000, which is strictly a U.S. stock market that represents 98% of the equities in the U.S. But it's the introduction of the Global BMI, we believe, will be a better fit, better relationship. It will be a broader index that kind of will give us a more accurate view of how your portfolios do from a global asset allocation strategy like we have. So we think it's a better comparison. If you look at page 1 of the newsletter, read down to the 3-year and 5-year alphas. They look really good with the Russell 3000. They look even better with the Global BMI. So if you can do that for me, that would be great. And that gives us a little bit of more comfort on being closer to an index that's comparable. Sometimes that'll hurt us, sometimes it'll help us, but I know change is hard, and the Russell 3000 has been kind of our go-to index, but we're going to change with the more recently used BMI Global Index. Fourth quarter, let's talk a little bit about that. Had a nice rebound with the sovereign debt progress. Some of the concerns went away there. Still aren't out of the woods as far as the potential recession there. Economy's still slow in the U.S. with our debt concerns. And obviously concerns with the election and the volatility keeps heating up. Year in review, we just had a severe extreme volatility. We had a lot of crisis that, you can see there all the way from Japan, Middle East, U.S. downgrade, Euro concerns. All of those crises put a lot of volatility into the market based on the uncertainty of what's going on there. That really drove that overall uncertainty of slow growth around the world. If you look at the U.S. economy, it grew at about 1.8% in the third quarter. We don't know about the fourth quarter quite yet. Not even certain I like the GDP anymore because our government has lied to us before about that as far as a number, a reliable number. But we'll continue to use it as long as we can. Growth really isn't large enough or big enough yet to cut through the unemployment problem. Personal income and spending is on the rise, which is a positive and driving that 1.8% GDP. But along with that, personal savings obviously has to be down. And inflation's been tempered. Although oil prices increased in the Q4, for the greater part of the year, they were in a negative or a declining cost situation. The ISM manufacturing service indices remain positive but slow. Exports are rising. The dollar value improved a little bit in the fourth quarter, so it wasn't good for the exports, but for the whole year, the dollar did decline, and exports obviously benefited from that. Businesses are still cautious, though, with tons of cash on the sidelines, and we're just waiting for them to feel enough confidence to get that out of their pocketbook. Home prices decline again, but on a positive note, sales prices, or sales actually volume-wise, was up. Looking forward, we still look at 2012 as modest growth, pretty flat domestic returns for the 2011, very negative international returns. We think that can be a modest growth number going forward. The biggest unknown, obviously, is Washington and how they address the debt and some of the growth issues from a job standpoint. When we get to the year end, I think we'll have a clear sense of what the political side looks like. They've appeased us a little bit with the payroll tax holiday being extended through February, but again, that has to be extended, I think, a little bit further down the road because it could possibly take as much as 1% away from our GDP. And then the big thing, again, can our governments make good decisions? And they really haven't brought a lot of confidence to the table yet in the last year and a half, 2 years, that they can do that. But let's hope that politics goes away and decisions for the better world would be of paramount concern. Bond market, if you look at the fixed side of the world, the U.S. and debt problems really strain the markets. U.S. and foreign debt problems strain the markets. Interest rates rose overseas. People kind of favored the U.S. dollar. So from a demand standpoint, tips in the U.S. were up about 2.7% in the fourth quarter. For the year, 13.6%. Nice returns on the high yield side, up 5% for the year. Muni bonds did well in the fourth quarter, finished over 10% for the year. Long-term treasuries, 29.2%. Most of that came in the third quarter, but again, an astounding total return in a 30-year treasury that nobody really at the beginning of the year could have guessed. Overseas markets suffered greatly. Barclays Global aggregate global bond was flat to the world for the fourth quarter, up about 5.6. The emerging markets were down about 1% in the fourth quarter, down 5.2 for the year. So again, better pricing, better valuations, better risk on the emerging side and the global bonds, yet they didn't live up to what the dollar did for the domestic stock or bond market. So a little bit strange for us because, again, we're value-oriented, looking more for global bonds to do a little bit better or significantly better this next year looking forward. Major central banks promised that cash flow if there were concerns with the European debt, which increased the confidence in the markets over there. Lower interest rates, we think, will help the banking system. Again, policymakers are a big player in what's going to happen and how quickly they act and what they do when they do act. Fundamentals are still strong. Corporations are issuing more debt at low interest rates. Default rates are very low. Emerging balance sheets are better than the U.S. Now, can they be rewarded is the key. Turning our attention to the domestic side of the world and the stock market, what a year of volatility. I mean, if you go back in my 24 or 25 years of money management, I don't think I've ever seen the volatility this great. And then actually through the end of the year, very, very little change in the market. Small caps were up a little bit, or large caps were up a little bit, small caps down a little bit. Fourth quarter was strong for market capitalizations, particularly the risk side of the equation, with small caps up 15.5, mid caps up 12.3, and large caps about 11.8. For the year, that was the opposite. Small caps did worse than mid caps at -4, -1.6, and then +1.5 was really the large caps ruled the roost for the year. Value stocks outperformed growth stocks for the quarter, 13.3 compared to 10.9, but growth stocks outperformed value stocks for the year. So for the quarter, value outperformed growth. For the year, growth outperformed value. Energy industrials were up significantly. They were the leaders. Financial stocks were down. The best performer for the year was utilities at 14.8%. The worst was the financial stocks at 18.4%. And as always, it's always an encouraging sign to see IPO activity increase. Initial public offerings obviously have increased drastically. So looking forward, what we see for the market is, still uncertainty based on what happens in Washington and the Europe cloud picture of the debt. We need to brace for more volatility, and stock valuations are still good domestically, still good internationally. We have PEs that are low, high corporate cash position, as we've already talked about, profit growth in the 8 to 12% range. So everything looks positive. We just need to get some growth momentum to gain some confidence that will go up long term. International stock markets, dollar was strong, kind of hurt the foreign returns. Took away about 5.7% of the total return for the emerging market index in 2011 just because the dollar improved. So that hurt us a little bit too. Fourth quarter, we managed modest gains on the international side, but the year was very negative. Global BMI was -7.7. The international EFI developed in Europe, Asia, and Far East, -12. Emerging markets, -18.4. So again, having a view that is the best buy and the best growth potential around the world was not rewarded in 2011 for us, and basically that's the reason we underperformed as much as we did. China down 19.9% for 2000, Europe down 17.8. So just some crazy numbers. Looking forward, we think that the poor year is traditionally followed by a pretty good year. If you look at statistics over the last 20 years, every year that the domestic or the foreign markets went down at least double digits, we saw at least twofold better returns the following year. So again, some really good contrarian views here if we can be patient. Very good pricings from an earnings and growth standpoint. The PEG ratios are near all-time lows. China and other emerging countries will really be focusing more on stimulating the economy than fighting inflation last year, where they were raising interest rates. They'll be lowering them. Really good news for 2012 there. And the European crisis in and of itself beat a lot of the multinational stocks down. So we look at the domestic multinationals as having some really good upside potential as well. So in summary, we want to make sure that you understand that there's still some things that are out there risk-wise, that risk is still prevalent, but a lot of the good things are just overshadowed by the uncertainties that are out there. There's great value, with all of the uncertainties and the volatility that's been created. There's value out there. Once we get rid of that fear part of the equation, I think people will always come back to that. We think 2011 was one of the years where people looked at the safe route. We think 2012 will be rewarded for taking risk, and we believe that that's going to benefit our allocations tremendously. So the opportunity is knocking. We want to thank everybody for their confidence in what we do for you and how we do it, and encourage anybody, if you have questions, to give us a call. Any friends or family that would like us to help them out, please send them our way. That'll help reduce your fee from a referral standpoint. And really, the All-Star team thanks you tremendously for everything that you do for us and the confidence that you've shown us. Give us a call if we can help you out. Thanks, guys.